All right, let's go ahead and get started. Pass this on to Scott, Andrea, and Matt. And Scott, you should have control.
Right. Welcome, everybody. Glad to have you here as we talk about leases, and we've got a lot to cover in the next hour. This will be so we'll kind of pace this fairly quickly. This is meant to be just kind of a broad overview, but get into a little bit of detail so that you have some meaningful information as well. I'll be presenting. Matt and I are both in our national assurance office, and we'll be presenting the GAAP treatment of leases. We'll be splitting that up. And then Andrew's going to talk about the tax implications. We're going to go through kind of the definition and talk about some of the accounting treatment. We're going to hit a few highlights, some of those things, and then we'll kind of build from there. As I get into this, the first thing I wanted to cover was the current accounting treatment, mostly because I'm going to build on this in some subsequent slides. Right now in our current accounting lease treatment, we have two different types of leases. We've got capital leases and operating leases. Anybody that's dealt much in the leases are probably familiar with those. And as we talk about, the capital lease, down below there's 4 criteria, and I'm going to go over those just real briefly, but they will come up later in the presentation as we bridge from the old guidance under 840 into the new guidance of 842. So with the capital lease, there's 4 criteria that could trigger capital lease. First is, does the transfer of ownership at the end of the lease term, or is there a bargain purchase option? Or if you've used up, in this case, 75% of the useful life of the asset, if you've used up most of the asset, that would be considered a capital lease. Or when you take the present value of the minimum lease payments, if it's at least 90% of the fair value of the asset, you've essentially paid for the fair value of the asset, you've bought the asset. So those would be capital lease considerations. And again, we're going to go over those because those have been modified. They still exist to some degree with some principles-based modifications in the new standard. As we get into the new standard I think many people are aware of this already, but this mostly impacts, equipment and real estate leases. And it'll take operating leases and gross up the balance sheet and put those operating leases onto the balance sheet, something that we haven't had before. There will be a liability for the obligation for that lease over its life, as well as an intangible right to use asset. And we'll go through an example of that. Matt will go through an example of that later in the presentation. Some of those, the concept behind this was really a level of transparency. There's some struggle at times on whether or not a capital lease is really a capital lease or operating lease, if it's right on the cusp of the 75% or the 90%, and while there is disclosure of this, there was some appetite by users of financial statements to see that obligation on the balance sheet of the financial statements. Hopefully I don't lose people's interest with this slide, but not quite a year ago, last July, the FASB approved to delay the standard for 1 year. And it took a couple of months to walk through the due diligence process of that, of putting together an exposure draft and getting feedback and comment letters. And so initially and this was just for non-public companies. So for non-public companies, they were supposed to have adopted this year, 2020. It got deferred 1 year. A couple of months ago, with the COVID things happening, FASB actually deferred several of their standards. And so actually leases got deferred another year. And I'm going to break this into 2 pieces as far as that deferral goes. One is we use the term all other, meaning non-public entities. So privately held businesses, not-for-profits. So they got deferred another year. So now their implementation year will be 2022. There are certain not-for-profits that actually qualify as a public business entity because they're a conduit debt obligor or conduit bond obligor. And because they have those publicly traded debt securities or publicly traded bond securities, they actually trigger the earlier effective dates of many standards. In this case, it was actually deferred for that group also if they hadn't already adopted and implemented. So they got deferred another year, which would put them in this fiscal year 2020 if they haven't already issued their financial statements. So for our June 30 year ends, they'll get another year out of that. For the 12/31s that haven't already adopted last year, then this will give them an opportunity if they haven't completed that process. When we get to the adoption, there'll be two methods that you can use. One is both of these are considered modified retrospective approaches, but the first one is you can adopt it for all the standards or all the years that are presented. So if you have a comparative financial statement, you would present it for both years. You could also just present it for just the current year. Um, and then if you choose to do so, then you'll have dual disclosure, both the prior year under 840 and the current year under 842. So your disclosures become a little bit more um, split apart and unique to some degree because you'll have disclosures under two different standards. But there is that option. Then you only have to do the financial reporting, the accounting, and the balance sheet for the 1 year. So let's talk about some of the highlights for this lease standard, just so we have kind of the same perspective on some of these details. The first thing I have pointed out here in the top is that this does not impact leases that are less than 12 months. Really what this impacts is if you have an entity that will rent, say, a piece of equipment, for example, a backhoe or a forklift for 3 or 6 months for a particular project, then those types of short-term leases that are less than 12 months are excluded. You are not required, even if they cross year end, to go back and try and put those leases on the balance sheet. So those are excluded. The expectation is that the income statement impact is actually fairly substantially the same. So your rent expense should be pretty similar to what it was before. Again, we'll go through some examples of what that looks like, but this is primarily a balance sheet exercise and just a way to get that obligation presented in the face of the financials. Um, Again, we'll go through a few more examples. I'm just going to kind of skip to the next slide that's got some more highlights here. There will be some discussion on lease and non-lease components. So for example, if you have a lease that has a, let's say you've leased some real estate, but included in that lease is also maintenance fees, janitorial fees, those types of things that are included in your lease payment. You don't pay for those separately. Then those components, those non-lease components, could be split out and considered a period cost. One thing I really want to emphasize is this middle bullet point here, talking about related parties. With these related party leases, there's a shift here from substance over form. A lot of times we talk about, well, what's the substance over form? In the new standard, it's what's legally enforceable terms. So I'm going to talk about that from a couple perspectives. One is if related parties decide to go month to month on their real estate leases, for example, we would look at the legally enforceable terms of that, not just substance over form that they're never going to leave the building. And so that becomes really the crux of whether or not you would recognize this lease as a lease that's in excess of 12 months. However, we do need to take into consideration any sort of indirect considerations, such as if the lessor, the entity that holds the building, if they've got some debt covenants or some debt arrangements with a lender that include a requirement for the operating company to continue to lease that facility. There might be, even if they structure something in between the two related parties, the two entities that would go month to month, there could be some indirect way of capturing them back into this. So that'll be something to consider. But again, it's really based on the legally enforceable consideration. So let's jump into what is the definition of a lease. As it says here, it's the right to control an identified asset. What that means is, in terms of identified asset, if you look at identified asset and you go to the third point there, that means that the supplier does not have a substantive substitution right. In other words, if you rent a piece of equipment, they designate a specific piece of equipment, and that's the piece of equipment that you operate and that you will utilize. That doesn't mean that if there's problems with it, let's say, for example, you have 5 different copiers that you have in a lease arrangement with a lessor, and one of those starts to have some issues with it, and so they replace it. That would still qualify as a lease in this example. If that substitution right really means that the lessor could at any time come and exchange that equipment. Maybe you do have a lease to, where they're going to lease you 5 backhoes for the next 5 years, but they're going to keep the backhoes on their lot, and you just show up and you pick one of their backhoes that they have available. So you're not really designated a specific backhoe, but rather they've got 20 on the lot, and you know that you have rights to at least come in and show up at their facility and pick one of those and use it as you need it. But it's less designated to a specific asset. You're just picking one of the ones they have available. Those types of situations. We can get into more detail later on if you have questions. Reach out to an Eide Bailey consultant, and we'd be happy to talk about more details about that. And so the definition again is that you actually have control, of that copy machine, that backhoe, that dump trucks, whatever those facilities are, that you have the right to direct and use those. They've changed the name. So we used to have operating and capital leases. Now we have operating and we have financing leases. So from here in the presentation, as I use the term financing lease, that was formerly a capital lease, but there are some nuances and changes to that. So we talked about those criteria of a capital lease on one of the earlier slides. And these criteria are very similar to that when it comes to determine whether or not you have a finance lease versus a sales or versus an operating lease. The first criteria is the same, that the ownership transfers at the end of the lease. The next criteria is a little bit different. Before we had a bargain purchase option. Now they say the option to purchase the asset is reasonably certain at the end. So it may or may not be a bargain purchase, but if we think it's reasonably certain that they will exercise an option to purchase it at the end of the lease term, then that would be triggered as a financing lease. Again, a principles-based that lightens up the language and has a more principles-based approach to it. The third criteria is that the lease term is a major part of the remaining economic life. In other words, before we said if they used up 75% of the useful life, and the 75% was a line in the sand, it was a hardened rule. Now, 75%, if you look at the practice guidance, they still use 75%, but it's a little bit lighter, saying that they use it for the majority of the economic life. In other words, the majority of the useful life of that piece of equipment. So if it was 70%, that might be close enough. If it was 72%, that might be close enough. And so 75% is still used as a rule of thumb, but it's no longer a black and white line in the sand type criteria. The fourth one is, again, similar to the previous criteria, but again, put in a principles-based approach. The present value of the lease terms equals or exceeds the substantial fair value of the asset. Before, if you remember, under capital lease, we say that the present value of the minimum lease payments are 90% of the fair value. Well, now they just say that it substantially equates to that fair value. So, we had situations where, as we were consulting with clients, they might do that math, and of course, as they determine the present value of the minimum lease payments, there is some subjectivity determining which assumption they're using in terms of discount rates and those types of things. And if they ended up coming up with a 89.4%, we would have concluded that it was less than 90, and so it was an operating lease versus a capital lease. Now, if you end up in 89% or 88%, perhaps that still follows this this criteria of it substantially equaling the fair value. So again, with this principle-based approach, a little more latitude in determining really what's the true intent of this. Before, it made a big difference whether or not you're, determining a capital lease versus an operating lease, or in this case, a financing lease. It made a big difference because it made a difference on whether or not you were going to put that asset as well as that liability or that obligation on the balance sheet. Now, the difference between a financing lease and an operating lease certainly have some different criteria as to how they're accounted for, but they both end up on the balance sheet. So maybe it's less relevant how close they are, how precise they are to that 89.4% being a cutoff for whether or not. And so those are the types of things that we'd evaluate. So it's more than just that initial lease term. We have to consider all the relevant factors of how long do we think we're going to be in this relationship with this lease. So with that, I'll hand it over to Matt, and he's going to continue to talk about a few of these terms and then walk us through some examples.
Great.
All right.
Thanks, Scott.
Matt, you should have control.
All right. Thanks, Amy. See if I can advance a slide here. Thanks, Scott, for kind of getting us kicked off on the new FASB guidance on the lease standard. So I'm going to continue to talk about some of the details related to the standard and some of the changes with this standard versus the 840 leases. First thing I'm going to go through here is lease payments. And so when we're talking about minimum lease payments throughout the period or throughout the lease, we're going to use these payments to determine the classification of the lease, either operating or finance. And under this standard, that classification doesn't matter quite as much because they're both going to be on the balance sheet as a liability and an asset. However, the subsequent accounting after that for an operating versus a finance is slightly different. And so determining classification is one aspect of these lease payments. And then the more important aspect of these lease payments is really that this is how you recognize that lease liability. So all of these different payments are included in that present value of lease payments that now gets recorded as a lease liability and then also as a corresponding right of use asset. So getting into some of the items that are on here for lease payments. First one, fixed lease payments, fairly straightforward there. The one little nuance is that second bullet point for in substance fixed payments. And so what is that? The standard talks about if a payment doesn't create genuine variability or there's an option for what type payments are out there versus, for example, an option could be you pay $200 a month for a vehicle or you pay $100 a month plus 10 cents per mile. Well, there's an option there. And so if there's an option, you would take the lower fixed payment within that. So in my example, you'd take the $100 and then that would be calculated as part of your lease liability. I call that minimum lease payment throughout the term. So in substance, there's a fixed payment, even though there's option and a slight variability within the payment there. The second one down is truly variable payments. If it's truly variable, meaning that it's based on usage or performance, once again, that vehicle, let's say the only thing written in that contract is you pay 10 cents per mile. Well, that's truly variable. So that is excluded from these lease payment calculations. But there could be variable payments that are based on a rate or an index. So let's say it's a consumer price index. Maybe you have a market interest rate that is based on. Those are variable payments. And the base rate for those is included in the lease payments. So at the commencement date, it's based on a certain CPI index. Well, whatever that CPI index is at that commencement date, that amount will be included in the calculation of your lease liability. And then the increase in CPI over time will actually really just be a period cost that'll be expensed as a variable lease payment. And so you have to have a truly variable lease payment based on that usage or performance to not have it included in the measurement of the liability. Some other things that are included in the measurement is residual value guarantees, anything on the lessee side. So if the lessee is probable that they're going to owe some money to the lessor at the end of the term, that amount is included as part of these payments. On the lessor side, if they're going to get that full payment of that residual guarantee by the lessee or a third party, that's going to be included in the measurement there. And then the final piece here kind of goes back to what Scott was talking about as far as the classification. So if we're reasonably certain to exercise an option to purchase the underlying asset, that buyout option, that dollar amount will be included in these payments. Well, then also on the flip side, if we're reasonably certain to terminate that lease at the end of a period and there's a penalty for termination, that amount would also be included. An example, I was working on a client when they had rail cars. So they had a rail car lease, and at the end of the term, they always renegotiated these things. So they were going to terminate that lease. They're reasonably certain that they were going to do that. But there was a penalty associated with that they had to make a payment to return those rail cars to a certain destination. And so that penalty is included in this lease in the lease payments, which ultimately is included in the lease liability. So Scott touched on this a little bit. The components of a lease, really there's a lot of allocation that can happen within the lease. The first one is lease components. So you could have, I guess the classic example is you rent a building or some kind of real estate space while there's land underlying that building. And so if you have the full capacity of that building, you're also renting the land there. And so you would have to separate those two pieces into two different lease components. And I guess the caveat there is this says if it's significantly different result, meaning I guess an insignificant different result would be that when you separated those two out, both of them were under an operating lease. They were both under the same term, and so you'd really get to the same place if they were accounted for as a combined asset. Then you would not have to do the allocations of all the costs and everything throughout. So that's the first step, is identifying the lease components within there, and then you get down to non-lease components. So back to that real estate again. If you have common area maintenance charges, those provide a good or service, but it's not related to the actual asset that's being leased. And so that's a non-lease component. And so there's some allocation that would have to be done between those two pieces as well, between the lease component and the non-lease component. And that allocation is done based on the standalone fair value, or the standalone lease payments. I shouldn't say lease payments, the standalone payments for those individual components, and allocation is done there. And I will say there is a practical expedient to make some of this a little bit easier, as you can elect to not separate lease and non-lease components apart. And you make that election based on class of underlying asset. So for instance, all of your real estate leases, you didn't want to separate out those two. You would just put them together, and you would include that all as lease payments, and they would all be included in that lease liability that's out there. And so I guess you'd relieve yourself from some of that allocation between the two. And then the final piece I want to talk about is what's not a component. So if there's an item in the lease that does not transfer a distinct good or service, such as taxes or insurance, back to that real estate example, a lot of times you might pay tax or insurance. Those are not a component. And so they do not get any allocation. However, those taxes and insurance are still consideration that's in the contract. So they're still included, but they are not separately allocated a portion of they're not a component, so they're not separately allocated any share of the payment. Going on to the lessee accounting, how do these things actually make it on the balance sheet? We've gone through a lot of information here, identifying the leases, separating the leases between the components, lease and non-lease components, defining what the lease term is, and the lease payments. So finally, the last step here is getting these things actually recorded on the balance sheet. And the recording on the balance sheet, there's a liability that we've all heard about, and there's also a right of use asset out there. And you'll notice as we go through this between an operating lease and a finance lease, they really start out the same, and then all of the accounting after is where the difference between the operating and finance lease come into play. So with that, we got the first polling question here, just to make sure everybody's still on the line. So the first one is, what is the more significant consideration for related party lease recognition? And Scott had talked about this, the substance over form or the legally enforceable terms and conditions.
All right, so that poll is open. Sometimes it can hide behind your presentation, so you might have to like minimize it and bring it back up.
And while people are looking at that question, answering that polling question, we did have a question pop up in our chat that asked, when it comes to financing leases, I talked about the 5 criteria. And the question was, how many of the criteria do they need to meet in order to be a financing lease? It's actually any one of those 5 criteria. So they just need to meet one, and that would be considered a financing lease.
All right, so we're going to go ahead and close this poll and hear the results.
That's good. The actual correct answer is in the minority here, but the legally enforceable terms and conditions of a related party lease are the ones that should be used in recognizing that lease. So focus on the lessee accounting. Like I said, on the balance sheet treatment, the right of use asset, lease liability, going to be the same. We're going to start in the same place for a finance lease and an operating lease. And then when we move to the income statement is where it gets a little different. Finance lease is going to act very similar to how a capital lease currently is recognized. You're going to have the amortization of the asset, and then you're going to have some interest expense on the lease liability. And an operating lease, actually the income statement recognition is going to be the same as 840 as well. You're going to have a straight line lease expense that's recorded over the term of the lease. And then moving to the cash flow statement, once again, very similar to how it is now. Finance lease, you're going to have the principal payments are financing activity. The interest is an operating activity. An operating lease, all those lease payments, very similar to any rent release payments under 840. Those are generally operating activities in the cash flow statement. So now getting into an example, kind of pulling everything together here. So we're going to look at the lessee side of the accounting. So we got an equipment lease, it's 3 years, economic life is 5, payments of $2,000 a year, interest rate, which is going to be our discount rate here, is 7%, got the fair value of the asset, and then at the bottom is our present value of future payments of the $52.49. And so if we went through all these and knowing those 5 criteria, this would be a operating lease if we went through that analysis. And I see a question that came through the poll on what ROU means. I should actually say what my acronyms mean before I just start using them consistently. ROU means right of use. So it's a right of use asset, is the asset that's recorded out there. So with this, getting to the example, so we have an operating lease. These are all the schedules that you would put together. This $5,249, that's where we start the asset. And then we also have a corresponding obligation or lease liability for the $5,249. That's where we start. And then we make payments, and then the principal portion comes off. The amortization of the asset is really a plug between the interest that's recorded and the straight line lease expense. So if we come down here to the lease expense, we notice it's $2,000 the whole time. That's the straight line expense recognition that's there. So then the amortization and the interest expense here, they combined up to that $2,000. An important note here that we call it amortization and interest here, but those are really combined into one single expense. And so they're not reported as amortization and interest expense on the income statement. They're both reported as together as a lease expense or a rent expense under an operating lease. And we'll see the difference here when we get to a finance lease there. So my next slide is, let's pretend all the facts are the same as we just had on the operating lease, except for now at the end of the lease term, the asset transfers ownership to the lessee. So in this situation, now we have a financing lease, and once again, the $5,249, that's our asset, and our obligation, that's where we start in the same place, but now the expense recognition is a little bit different. Now we have straight line amortization of the right of use asset of the $1,750 every year, and then we have expense recognition for the interest expense. And so if you see, our total expense actually decreases over time related to that reduction in the interest expense over time. So the expense recognition under finance and operating lease, that's where the difference is related to the standard. So with that, I'm going to move into the next polling question. Once again, back to something that Scott talked about a little bit there. So under 842 provides a bright line test that a lease term that spans 75% of the useful life of an asset triggers treatment as a financing lease. True or false?
All right, that second poll's now open. We'll leave it open for about 30 seconds.
I do see a question that came through the chat about no depreciation expense. I guess I'm not fully sure on what that is, but under an operating lease, there would not be any depreciation or amortization expense recorded. Under a financing lease, there would be amortization that expense that is recorded.
All right. Go ahead and close this poll here. And here are the results.
So the answer is false. So it looks like we got 58%. I got that one there. Although it is false, as Scott mentioned, that in the notes to the standard, they even talk about how the 75% test for the major part of the economic value or the 90% test for substantially all the fair value could be used as guidelines for, I guess, tripping either of those two elements to be a finance lease. So it's not a bright line test anymore. It's a principles based, but those old bright line tests could still be guidelines, but they're no longer bright line tests. Closing up the example that I have here, just some of the journal entries that go through this example. So day one, like we mentioned, the operating lease and finance lease, they start off in the same place, but then the expense recognition as we go through is different. And so you can see how the expense actually comes through here. You got on the financing side, you got the interest expense and amortization expense that are recorded. On the operating lease side, you just have that one lease expense that's recorded. So impact on covenants related to operating leases, because on the finance lease side, if you had a capital lease before, it'll most likely come over and be a financing lease. And so really there's not going to be a lot of accounting impact related to that. However, for an operating lease, these are no longer just hidden in the background off balance sheet. These are now on the balance sheet as a liability and also an asset. And so there could be some impacts. So current ratio impact, because the right of use asset is considered long-term, so it's recorded long-term, but there is a current portion that is related to the lease liability. So that could mess with some current ratios there. You could also have a liabilities to net assets or liabilities to equity ratio. That is impacted by adding more liabilities related to the operating leases, or even a return on asset if that's a ratio that's out there. Now there's more assets out there, so that ratio could be reduced if you have significant leasing activity or operating leasing activity. And then some ratios that most likely will not be impacted are a lot of the income statement type ratios. So an EBITDA metric, gross margin, maybe you have an operating ratio, a return on equity, things like that. Won't be a lot of impact there. I will say the EBITDA could be impacted if there is a change in classification of lease. So before you had capital leases and you go through the criteria and now they're operating leases or vice versa, there could be some impact on the EBITDA calculation. And I even heard some people say that there could be people that actually want to have more financing leases because they get that depreciation or that amortization and interest add back on their EBITDA. So it'll actually improve their EBITDA as opposed to just recording that single operating lease expense in the income statement. So a lot of information out there. Where do you even get started on this thing? So the first thing is you don't really know what you have until you go through the analysis and get yourself a complete list of all the leases, rental agreements, service contracts that you have out there. And the reason I put service contracts on here is there's something called an embedded lease. So it could just be a contract for, let's say, for instance, snow removal. I'm from the Midwest, I live in North Dakota. 6 months of the year we have to deal with snow. And so there could be a snow removal contract and you're thinking, hey, they just come clear the snow for us. But let's say you're a very large operation, they have a dedicated asset for that contract. You could actually be leasing the equipment related to that snow removal. So you could have a lease that's out there that's embedded in there. So You want to go through and look for recurring expenses that are out there, really get a solid list of all the leases that are going to have to be accounted for on the balance sheet. And then you're going to go through some of the accounting, going down to number 2, reviewing these contracts to make sure they're accounted for correctly, or if they're differently than you had been previously. Like I said, related to those service contracts, there could be some operating leases or finance leases out there that you really need to get on the balance sheet related to applying the new standard. Debt covenants, like we mentioned before, there could be some impact there, especially if you have significant operating lease activity right now. There's going to be a significant amount of liability that's added to your balance sheet. So you want to be mindful of that, talking to the bank if that's going to change any considerations. Lease versus buy. Before, you may not have wanted to buy the asset because you didn't want that extra liability, but now that liability is going to be there anyways, so you could have some different considerations there. Like we talked about, related party leases, making sure that documentation is solidified. Sometimes there's no contract related to these. There's nothing in writing. Maybe it's a time we want to get something in writing, so we have some legally enforceable terms that we can go to for how to account for these things. And then the last bullet point is, once you have a complete list, you kind of know how you're going to have to track all of these items. Do we need a software? If we only have a couple leases, we have a couple copiers, or we have a couple vehicles, maybe we don't need a software. But if we have multiple locations, we got a fleet of vehicles, a fleet of trucks, we got copier leases, we got real estate leases, kind of all over the place. We may want a software to track those and account for them. And there's a lot of good softwares out there that even track renewal options and kind of just maintenance of the leases as well. So kind of getting all the documentation in one place and a better way to track those, and then also calculate the accounting and all the accounting impacts that are related to leases. So some good options out there if you have significant leasing operations to implement a software to help you track everything. And with that, I'm going to get into the third polling question. And after this, we're going to hand it off to Andrea to talk about some of the tax considerations. So this third polling question, an organization could have an accounting policy to not record leases with terms of less than 12 months. True or false?
All right, the third poll is now open. We'll leave it open for about 10 more seconds if you want to answer. All right, looks like voting has stopped, so we're going to close this. Here's the results.
So this is true. Looks like about 80% got it there. You could have a policy that anything less than 12 months, once you've gone through all the considerations of what the true term is, taking into consideration anything you're reasonably certain to exercise, any options to renew there. So this is true. And with that, I'll pass it over to Andrea to talk about some of the tax implications of the new standard.
Perfect. Thanks, Matt. And yes, as Matt said, my name is Andrea Mao, and I'm part of our national tax group here. And we're going to touch on some of the differences in the tax rules relative to the GAAP rules that Scott and Matt just talked through. So some of our terminology is going to seem similar. We're going to use words like capital and financing and things like that. But the analysis process that we're going to apply for tax purposes will be different. And in many cases, we actually come to a different conclusion than the auditors do related to how these should be accounted for tax purposes. So for example, Matt and Scott talked about operating leases. Well, in the tax world, we don't really call those operating leases. Those are quote unquote true leases. Those are situations where the lessee is truly renting the the equipment or asset from the lessor. The capital and finance leases that Scott and Matt talked about, those really aren't thought of as leases in the tax context. Those are truly sale or financing transactions. So when you're talking tax, sometimes tax practitioners will not refer to those type of arrangements as leases. They will instead refer to them as sale or financing transactions, and reserving the term lease for the true operating leases that Matt and Scott were just talking about. The tax analysis process is a facts and circumstances analysis. There are a wide range of IRS rulings and cases that have highlighted some of the factors to consider in walking through this analysis that we'll talk about in a second. And as with a lot of tax principles, there are no bright line tests. There is no single factor that is going to make our decision for us. So like the question that Scott answered on, a lease is treated as a financing lease for book purposes if it meets one of 5 criteria. Well, for tax purposes, we don't have that kind of a rule. We're going to have to look at all 5 of those factors and weigh them against each other. It's possible that that one factor is large enough to tip the scales to make it a financing or sale transaction, but in other cases, if the other 4 factors are pointing the other direction, maybe it's not. So the part of the difficulty in doing the tax analysis is knowing that the book analysis may have not weighed all of the factors that we need to be looking at for tax purposes. If they've determined they've crossed one of those thresholds, they're done. They know it has to be a capital lease. They don't necessarily continue through the rest of the factors and see how they might be offsetting. That's something that we unfortunately need to do for tax purposes. And with all the changes that they're talking about in the GAAP world with the right of use assets and lease liabilities and things like that, those do not impact the tax rules. At this point, we have no indication from the IRS that they're intending to adjust the factors or criteria for accounting for these for tax purposes. So really, the overall impact of the new lease standards from a tax accounting perspective is that it could impact our deferred tax assets and liabilities related to the right of use and lease liability accounts that Matt and Scott were talking about, but it should not change how we are classifying our leases for tax purposes. Leases that used to be true leases are still going to be true leases, even if they go on the books for financial statement purposes. Capital or financing leases could still be considered sale transactions for tax purposes that would be reported consistently going forward. The primary criteria theme that you will see that run through the factors that have been identified for analyzing tax leases are which party has the benefits and burdens of ownership, which party has the ability or the power to gain economically or the risk to lose economically from this transaction. Who is going to eventually, if this transaction does not go as planned, it goes better than planned and one party ends up benefiting more, or it goes more poorly than planned and one party ends up taking a larger loss than they expected, that's usually the party that has the benefits and burdens of ownership. They're the ones at risk or potential reward in the arrangements. And so the lens that we use to review a lot of the factors we'll talk about is, okay, how does that impact? Does that move the risk to the other party? Does that move the risk back to me in this transaction? And in order for something to be a tax lease, the lessor must retain the benefits and burdens of ownership. So the lessor needs to be the one who at the end of the lease term still has some potential economic gain or loss of some sort. If they have transferred off their entire obligation and their entire economic rights related to that asset to the quote unquote lessee at the beginning, in many cases that won't be considered a lease for tax purposes because the lessor has no continuing economic right or benefit in the asset that has been leased to the other party. As I said, the factors, there are a lot of them, and we could probably spend several hours just going through some of these because there are a number of rulings, cases, different IRS pronouncements on these particular criteria, but these are the factors that need to be considered when we're looking at, okay, who has the benefits and burdens of ownership? So who's getting the profit from the property's operation? At the end of the lease, when it comes back to the lessor, is there still some economic value in the asset that the lessor can take advantage of, either by selling it, by using it themselves? Then there's more likely to be considered a true lease when the lessor has a continuing potential economic interest in the property. Is there a way, does the legal title pass? That is something we need to look at, but isn't necessarily definitive. We can have situations where title doesn't move, but the benefits and burdens of ownership have moved, meaning that the lessor is no longer the owner of the property, even though it still might be titled in their name. How the parties treat the transaction can be relevant also. Occasionally, when you're dealing with large leasing companies, their standard lease agreements will state clearly which party is going to be considered the owner of the asset during the lease. That is partially, for them to achieve the result that they want and achieve clarity in terms of which party has which rights. The IRS won't always respect those, but typically they will if both parties have agreed on this, and that is typically represented also in the economics of the lease and the costs of the lease. They will take that into account and perhaps weigh that heavily in favor of the proper classification. And then, as I said, who has the economic loss if something goes wrong? What happens if this whole thing blows up and this asset becomes useless next year? Who really suffers loss here? Is it the lessor or is it the lessee that is using the asset at the time? A couple common provisions that we see in rental agreements, purchases and renewal options. Our analysis here is going to be somewhat similar to what Scott and Matt were just talking about. We're going to be looking at what are the likelihoods of this being exercised? What are the economics of the transaction? So if I'm going to pay $100,000 in rent for a particular piece of equipment for 5 years, and I have a $1,000 purchase option at the end, I'm probably going to be treated as the owner of that equipment because I've already paid 99.9% of the actual cost of the asset. So exercising the lease, or exercising the option at that point is kind of a no-brainer. Typically, if that option is tied to fair market value, and will at least represent what the parties expect fair market value to be at the end, then they will still respect it as a lease and not treat it as a sale. So in that case, you were looking again at, okay, what was the party's expectation when they set this up? Do they really think the asset's only going to be worth $1,000? Is that true? Or is it something where we're just going to give you a discount on this because it's going to be easier than us taking it back? We'll just take a little bit of money from you and give it to you, even though the fair market value of the asset is considerably higher than that. Those are things we need to look at. Similarly, in the rent-to-own context, again, we're looking at the significance of the rent payments relative to the fair market value of the asset and a potential purchase option at the end. Again, if I'm crediting all my rent payments towards a future down payment, and at the end of the lease term, I have paid more than 80% or 90% of the down payment, it acts more like a mortgage in some ways where, hey, I should be treated as the owner of that property because once I started making these payments, it was pretty much, I was economically compelled to continue to make those payments and to move and to go through with the ultimate purchase transaction. There are provisions in certain vehicle and equipment leases called track provisions. They're terminal rental adjustment clauses. And that is a situation where the lessee and the lessor agree on the value of the property at the end of the lease. So if you think about a car, a car lease, a typical 3-year car lease, I'm going to lease this $50,000 vehicle for 3 years, and I'll agree with the dealer that at the end of this time, we think the car is going to be worth $20,000. If that's a reasonable assumption, then the IRS may respect that. And so we say that this is going to be worth $20,000, meaning that if I bring it back with too many miles on it, I have to pay to make it worth $20,000. If I return it with fewer miles on it, the dealer gives me credit back because it's worth more than the $20,000 that we agreed on. If the IRS has looked at these in the past and will occasionally overlook them in determining the proper classification of the transaction, they just put this particular factor aside and say it's neutral. It doesn't support one treatment or the other, and then look at the rest of the lease to determine the proper classification for tax purposes. The stakes of the tax classification here are not a permanent difference, but a timing difference. So regardless of whether we decide to treat this transaction as a true lease or as a sale or financing transaction, both parties are going to achieve the same overall income or loss on the transaction. It's just a matter of when. What we're talking about is when these items are recognized for tax purposes, not the total amount of income that people are going to achieve from the transaction. And as we'll talk about in a second, the depreciation is going to be a very significant factor here in how these are actually reflected on tax returns. So in a true lease context, the lessee, all their payments are deductible rent expense. The lessor has includable rent income for the total amount of payments received, and the lessor retains the depreciable interest in the property. In a sale or financing transaction, now those lease payments turn into basically loan payments, a portion of them being a principal payment and a portion being deductible interest expense. The lessor, they have gain now. They have been treated as if they had transferred the asset in exchange for the payments. So now they have a potential gain or loss on that sale transaction. The payments that they receive will be treated as return of principal or interest income. Again, similar to what you would see in a typical financing arrangement. But in this case, the depreciable interest shifts to the lessee. The lessee becomes the owner of this property at the beginning of the term, and the lessee is the one who is entitled to depreciation and potentially bonus depreciation. And a very quick example here, just to illustrate the potential timing impact of this classification. This is a situation where we have business A is leasing a piece of equipment to business B. We have a standard monthly payment over the term of the lease. The $234,000 in total payments. The total cost to the equipment was $180,000, and then our AFR is going to be, that's the applicable federal rate as published by the IRS, and that's going to be the discount factor we use for the lease. So in this case, our lease started at the beginning of 2015. So if at the end of 2018, we will have been through the first 4 years of the lease, 15, 16, 17, and 18. If we treat this as a lease, as business A, that means that all of the payments that I've collected, my $18,000 a year, have all been lease income. So at the end of 4 years, I have $72,000 in income. But because that equipment qualified for bonus depreciation, I have written off the entire cost of that equipment, meaning that through the first 4 years of this lease, I've generated $108,000 in tax deductions. Now we turn and pivot to the back end of the lease, and all I have coming my way is income. So at the end of the day, we're both going to get to the same overall tax impact for this transaction. But as you'll see from treating this as a lease, and one of the main benefits for business A to treat this as a lease is the cash tax savings of being able to accelerate those deductions and push the income towards the end of the lease. In contrast, if this is treated as a financing transaction, the overall income loss is relatively flat over the term of the lease. We'll have a small loss initially on the sale. That's due to the amount of interest that we had to factor into the lease payments to reflect the financing nature of the lease. And our interest income is going to be roughly, it's going to shift a little bit over the term of the arrangement, but at the end of the day, we're all going to get to the same place. But treating this as a lease allows me to accelerate significantly the deductions associated with the property. So what happens? We're going through our tax analysis and we decide, oops, this is classified incorrectly. This should have been a lease, and instead I've treated it as a sale, or vice versa. We do have an accounting method change for that. For tax purposes, when we change how we're accounting for something, an item of income or expense, we need to notify the IRS. We need to file a Form 3115 and take into account the overall difference in tax impact between what we did do and what we should have done under our new method of accounting. Since this qualifies for automatic consent, that means no filing fees. We can file it with a currently filed return by the original or extended due dates. So we can still file these changes for 2019. And recently, the IRS is basically at this point now annually updates the list of automatic changes, and they made some important modifications to this change at the end of 2019. So those of you who have maybe heard of this before or looked at this before and said this is a bad idea, it probably was until the end of last year. The new automatic change now allows us to take into account a 481A adjustment, so we can now do a cumulative catch-up adjustment for the income and expense that we misreported in the past. We will need to attach to the method change request a list of the counterparties to the leases. We don't need sign off from the counterparties, which is what would have been required under prior rules. We don't need a list. We don't need any sign off from them. We just need to list and identify those counterparties. One of the main things the IRS is worried about in this scenario is actually that we have both parties taking depreciation on this. That's one of their big concerns about leases, is we may take one position and the counterparty may take a different position, and at the end of the day, look at that, we both got bonus. That's what they're worried about. So to the extent that we identify the counterparties, that allows the IRS some potential ability to determine that we aren't double dipping on this. The other thing to keep in mind here is technically this does not prevent the IRS from later challenging us on exam that our classification is incorrect, but it at least allows us to true up the factors. And then I think we have our final polling question here. True, false, financial accounting and tax accounting always classify leases in the same manner.
All right, we're gonna leave this poll open while Andrea finishes up.
All right. So the last slide here is actually another issue that we see come up quite frequently in the tax space, and that it is a book tax difference in accounting for leases that have increasing or decreasing rents over the term of the lease. So for example, it could be a lease that says, or the lease payments increase 5% every year, or there's a large balloon payment either at the beginning or the end of the lease, or a rent holiday. Typically what happens on the financial statement side is they straight line the total amount of rent due over the term of the lease equally over the term of the lease. For tax purposes, that can be the correct answer, but is generally not. There are very limited circumstances where we are required to straight line that rent over the term of the lease. Instead, we are typically following the payment schedule, and so we will see book tax differences for the amount of rent that is accrued each year between the straight line rent and then what is actually shown in the lease agreements. That is also an automatic accounting method change. So if you have a deferred rent liability on your balance sheet, perhaps, or some sort of deferred prepaid rent on your balance sheet, and you're taking a straight line for book and we don't have a book tax adjustment, that's something we need to look at, and it can again generate an automatic 3115 so we can take care of that. And I think that's all we had. Scott or Matt, were there any other questions that came in you wanted to answer?
We had several questions that came in, and we just answered them both in the chat and the Q&A. We just answered them separately. So,
Okay.
but if anyone has additional questions, our contact information is out there. Don't hesitate to reach out, and we talk about your specific circumstances.
Perfect. Yep, and there it is. There is our contact information.
Perfect.
Let
Well,
us know.
you guys can reach out if you have any questions. Otherwise, thank you all so much for attending, and thank you to our presenters. We hope everyone has a great day.
Thanks, Amy.
Thanks, guys.
Thank you. Have a good one.
You too.